Hello, my name is Eric Jefferson, Managing Partner, Trestlebridge Capital, and Chief Investment Officer at Flagship Harbor Advisors. I want to thank you for joining us for the first of what will be a regular communication with the goal to quickly recap everything taking place in markets, as well as dissect some of the key themes that are driving performance, and then share a few timely ideas that we think are relevant based upon the current market and business cycle that we're in. So starting with last week, we saw stocks down about 1%, despite a strong rally on Friday. Fixed income traded higher in what felt like a classic risk-off week. There were really three data points that we got that drove performance. First was around inflation. Secondly, on retail sales, which really measures the health or sentiment of the US consumer. And then finally, we had the start to the Q2 earnings season. So taking those three in order, inflation in the month of June came in at 9.1% year over year. First, that is a historically high figure. Secondly, and arguably more important, that is going in the wrong direction. We've talked about the importance of having inflation eventually moderate. That will allow the Fed to back off their very hawkish rhetoric, their very aggressive campaign towards combating inflation. And unfortunately, this print is going in the wrong direction. If we strip out the more volatile components of inflation, things like food and energy, that core reading remained firm, did modestly decelerate, but certainly not to the point where we think the Fed will get more comfortable with the environment that we are in. As a result, when we turn to fixed income markets, we saw the yield curve move from modestly inverted to very inverted. What I mean by that, the front end or the short end of the curve, that trades in anticipation of future Fed funds rates. That jumped higher, but we actually saw the 10-year rate moderate. That's somewhat interesting or curious move. Typically, longer-term bonds will trade based upon inflation expectations as well as the outlook for growth. Again, if you think inflation is going to remain stubbornly higher for longer, you typically wouldn't want to buy a long-term bond, lock in that lower rate of return, and eventually lose your purchasing power. I think what explains a lot of this, we got a recent survey from the University of Michigan that indicated that long-term inflation expectations have actually come down quite significantly. Again, that doesn't do anything to solve inflation overnight. It sort of reinforces the idea that inflation, although not transitory, is somewhat of a temporary phenomenon that we will simply have to work through before we can have an economy on firm footing going forward. We also saw the rally in treasuries. Again, really that behaved more as a safe haven play or a flight to quality. That is somewhat of an ominous indicator. Again, people are buying these traditional safe haven assets in anticipation of potential future equity volatility. The one silver lining with that is if we do have further declines, we'll talk about earnings outlook in just a moment. If we do have further declines in the equity space, the fact that bonds traditionally act as that buffer to equity volatility may actually be returning to that role. As we've talked about, part of the challenge this year with the 60-40 portfolio is both stocks and bonds have got absolutely decimated. That is a very, very unique environment. We've only had a bear market in both of those asset classes 3 times, with 2022 being the worst, again, in the history of capital markets. So some silver lining, if equity volatility does persist, likely may see fixed income act as more of that buffer, hopefully offset some of those drawdowns. Second piece, when we think about direction of inflation, we did see gas prices drop for the 28th straight day. That is a record, although do anticipate that trend may be coming to an end. We had energy stocks up big today, oil back over $100 a barrel. That was following President Biden's trip to Saudi Arabia that did not result in any commitment to increase production. A second data point from last week was retail sales. That came in slightly above expectations. That was actually somewhat encouraging. Again, retail sales really measure not the sentiment of the US consumer, but ultimately the behavior. We talk about the concern with inflation and higher prices. As things are more expensive, people cut back on their spending. That wasn't necessarily the case here, although as we unpack that data a little further, retail sales are measured in nominal figures, meaning they incorporate inflation or higher prices. If we look at volume, so the number of transactions that consumers made, That was somewhat flat to slightly negative. Again, like to see that going in the other direction, but the fact consumers have still continued to go out and spend, that's what's kept the economy afloat thus far. Certainly a good sign in the face, especially what is truly historic inflation. And then finally, I want to touch on earnings. As we talked about, earnings historically the number one driver of stock prices. The Q2 earnings season has officially gotten underway, about 7% of the way through the 500 S&P 500 names, and off to a somewhat mixed start. We have about 60% of companies that have beat expectations. That is somewhat meaningfully below the historical averages. The more concerning news, when we look at the future growth rates, those are somewhat sharply negative versus expectations for about plus 5%. Again, that would be the bigger concern. It's very early here, so don't want to have any knee-jerk reactions. But if earnings do continue to deteriorate going forward, that would likely put further downward pressure on prices. From a positioning standpoint, we absolutely think this is the time to incorporate those higher quality names in your portfolio, companies that have stronger balance sheets, that have more sustainable earnings growth, that could potentially withstand some volatility if we do continue to see a slowing economy. We also heard in a lot of the language or transcripts of those earnings calls from corporate executives hint to the fact that slowdowns in hiring may be coming. Again, certainly somewhat of an ominous sign. Not that those are automatically then guaranteed, but certainly that tells you something if corporate executives are setting the expectation that hiring may be slowing down. One silver lining, we did hear from a number of our banks that those groups rather, historically kick off earnings season. And one theme from a lot of those groups that have already reported, keyword has been the resilience of the US consumer. When we think about sentiment, that is historically low. People are less encouraged based on this economy versus where we were in 2020. But that being said, consumers have still gone out, continued to spend, still gone out, continued to buy homes, finance homes, etc. That is encouraging. Obviously, though, the direction of where we go from here, largely dependent upon what happens with inflation going forward. The week ahead, we do get some housing data. That's especially important just because housing does represent a good chunk of inflation. And again, real estate has been trading near all-time highs. As well, we'll hear from the European Central Bank, both get some inflation data. As well, we expect them to raise interest rates for the first time in a while. That's all for now. As always, please reach out if you have any questions. Have a great week if we don't connect. Take care.